Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zaegel. Today we have an exciting episode where we are going to talk about the big, beautiful bill that was passed in Congress and what planning impacts it has. Now, I'm passing no political judgment on the bill because I don't really care much for politics anyway, but this is an important one for financial planning and especially retirement planning. So I narrowed this down to 10 items. And this is still going to be a longer episode. And I know it's going to be a longer episode because I just recorded a video for our clients. I send out a monthly client video, and we just cover important items. And this was an important item. So I just went through and recorded that for our clients. Therefore, I know this episode is going to be a bit longer than usual. But these are 10 important items that I want to make sure that we cover in detail. Now, I'm going to put out a caveat that we dove deeply into these, but perhaps there is one or two wrinkles that we didn't capture. Those will be sorted out in time as we dig even further into this. But what we've got here is 99% solid. I'm not too worried about that. We dove deeply into this and double-checked everything in there. There's also the possibility that maybe down the road the IRS comes out with some other interpretation. We've seen that before when these types of laws are passed. So there's still potential for changes in these, but what we're going to cover is rock solid. And we can start looking at these items for planning and understanding why they are important. Unfortunately, I'm not able to say that these helped simplify things. In fact, quite the opposite. And as we're going through, I think you'll understand why I'm saying that. It unfortunately is adding more complexity to tax planning, but that just is what it is. We're going to roll with it. It does have a lot of benefits in there, at least a lot of potential benefits, and we don't want to miss those. So here we go. We're going to dive into the 10 items from this bill that we think are impactful to planning. We're not going to talk about things like energy credits or anything like that. There's a lot more to this bill than what we are going to cover, but these are 10 items that are very important from the retirement planning perspective. Number one, the first, I'd say half a dozen, we're going to be able to go through a little bit quicker, then it gets a little bit more detailed. So number one, the current tax rates are made permanent. So back when the Tax Cuts and Jobs Act was passed many years ago, 8-9 years ago, I lost count. I believe it was 2017 when that one was passed. When that passed, the tax rates decreased overall, a couple percent for most tax brackets, except for the higher tax brackets, those stayed the same. So those were decreased, but they were made temporary and they were set to expire at the end of 2025. Now, those rates are being made permanent. And by saying permanent, that doesn't mean that they can never change. It just means that Congress has to take some action. They have to put forth a new bill and actively make those rates change in order for them to change. So all that means is the current tax rates, they're not set to expire sometime in the future. Those are what they are right now, and they've been made, quote unquote, permanent. So that's the first thing. Second thing is on the state and local tax cap. You'll hear this commonly talked about as SALT tax, SALT, which stands for state and local tax. So there was a cap put in place on that, on the Tax Cuts and Jobs Act. The cap was $10,000 of an itemized deduction for state and local income taxes. Let's back up a little bit on that. On deductions on your tax return, you can have either a standard deduction or itemized deductions. You get the higher of the two. So your itemized deductions are state and local taxes that you paid, mortgage interest, and charitable contributions. Those are the three main ones. There can be some medical stuff, but that's very unlikely. It's generally state and local income taxes, mortgage interest, and charitable contributions. If the total of that is higher than the standard deduction, then you can take itemized deductions. So in that itemized deduction list is the state and local income taxes. That was capped at $10,000 back in the Tax Cuts and Jobs Act. Now that cap has been increased to $40,000. So there's virtually no cap unless you're in a really high tax state or you're a high income earner paying a lot of state and local income taxes. Now, along with that cap, though, is that $40,000 cap is only allowed for those making less than $500,000. So those that making over 500,000, their cap gets reduced. They don't get as much of a benefit for it. So all that being said is that this isn't going to necessarily impact a ton of people, certainly those that are in the higher tax states, especially those not making more than $500,000. It's really going to help them and lift the total itemized deductions and really start to give them a potential to take the itemized deductions if they are larger than the standard deduction. But for a lot of people, this isn't going to make a huge difference because the standard deduction will still be higher. That's all going to be on a individualized basis in terms of how much mortgage interest you have, how much your state and local taxes are. This is all going to vary widely, but it's important to note that that state and local tax cap increased from 10,000 to 40,000 because you don't want to miss out on some potential tax savings by having that state and local tax deduction. All right, third thing, I said the first six were going to go fast. The first two took a while. But anyway, the third thing is the pass-through entity tax remains in place. So here's what happened back when the Tax Cuts and Jobs Act was passed and the state and local income tax the deduction was capped at $10,000. Well, a lot of states said, okay, we're going to try to give you a workaround for this. And if you own a pass-through business, so a partnership or an S corporation, the business itself could pay the state tax on its income. And by doing so, that business gets a federal tax deduction. So this was the workaround to the cap on the state and local income tax. The states, one by one, said, hey, we are going to allow the business to pay the state and local income tax on its profits. The thought was that maybe if you increased the state and local income tax cap, that pass-through would go away. Nope, it gets to stay. So that benefit is still there for business owners. It's just important to understand that planning item because it can help save quite a bit in taxes. All right, number 4, the estate tax. So we talked about how the individual tax rates were set to expire at the end of 2025. So was the estate tax exemption. It wasn't totally going to expire. It was going to go back to its previous levels, which was about half of what it is now. What they did with this bill is they made the higher estate tax exemptions permanent. So for 2025, it's going to be $15 million per person, and that's going to index with inflation over time. Again, it's gone from temporary to permanent, so that way down the road, Congress can still change it, but they have to actively vote in order to do so. Number 5 is the child tax credit. So this is less important for retirement planning, but if you're not quite of the age to where you have to worry about this, or if you still have young children, just important to note that the child tax credit is increased from $2,000 per child to $2,500 per child. It looks like that is only going to go through 2028. So we're going to have 4 years, 25, 26, 27, and 28, where that is in place. So as I have been reviewing this, that looks temporary at the moment, but looks like for 4 years, that's going to go from $2,000 up to $2,500 per child. Number 6 is a new federal tax deduction for tip income and overtime pay. We don't know the mechanics on this yet, but I'm assuming this is somehow going to be reported on the W-2 and maybe have a line on the tax return, an extra line on the tax return. We don't know the mechanics yet, but we just know that in the bill there is a new federal tax deduction for tip income and overtime pay, which effectively makes those items non-taxable because they're getting deducted off the total income. Now, that is capped at $25,000, and it's also phased out for higher incomes. And that also looks like it's going to be effective through 2028, so the next 4 years. All right, so that was the first 6. The next 4 are a little bit longer, so we'll dive into some more detail and planning items on this. Number 7 here is, again, going back to itemized and standard deductions. So the standard deduction will currently be $15,000 per person, so $30,000 for a married couple, married filing jointly. Now, one little wrinkle that I don't fully understand yet, the mechanics of this, but it looks like for those that are in the top tax brackets, there's going to be a reduction of itemized deductions. Looks like it's reducing it by 2/37 from the value of each dollar on the itemized deduction. So more to come from that. If you're sitting in the top tax bracket and you're in a spot where you can itemize deductions, just know that it looks like there's a little bit of a reduction in that. But more to come on that because that isn't super clear with the wording in the bill. But just know that your itemized deductions might have a little bit of a limitation if you're in that top tax bracket. Now, here's the good news. The new good news, especially for retirement planning, is that seniors now get an extra $6,000 deduction per person on top of the standard deduction. So previously, when you were a senior, you got the standard deduction, and then they also had an additional deduction. And now on top of both of those, you were getting an extra $6,000 per person deduction. So if you're married filing jointly, that's another $12,000 deduction on top of the standard deduction. Now let's be careful. This is not a tax credit. This is a deduction. So you're just subtracting that amount from your income, and then taxes get calculated. But this can still be a really nice benefit. Now, this benefit, though, is phased out based on your income. And we're going to talk a lot about phase outs here in the next couple items. But that's important because we now have another planning item, especially when we're talking about things like Roth IRA conversions and such. It's important to understand that extra deduction gets phased out when your income for an individual gets above $75,000 or $150,000 married filing jointly. For every $1,000 that you go above those thresholds, you lose $300 of that deduction. So essentially, it's fully phased out by the time you get to $95,000 of income, AGI, adjusted gross income, for an individual, and $190,000 of adjusted gross income for a married filing jointly couple. So there's this phase out period where this goes away as your income gets up into those levels and beyond the top level of the phase out. And I mentioned already that this is an important planning item because it adds just another layer to be thinking about when we are planning for retirement income. We talk a lot about Roth IRA conversions. And when we do Roth IRA conversions, we have to be mindful of tax brackets, Medicare IRMA brackets. If you're not on Medicare yet, we have to worry about health insurance and health insurance subsidy, possibly. Now, we have this other planning item to consider, which are the phase outs for this extra standard deduction. Again, it's not a bad thing. It's just yet another thing that we have to plan for, another variable that we have to take into account. It may still very well be worth it to do the higher Roth IRA conversion, knowing that we're going to lose this extra deduction in the meantime. We just have to factor that into the calculation and say, is this worth losing that deduction in order to pay taxes now to save on taxes over the long term? And if you're not a regular listener of the podcast and you're wondering what in the world is he talking about with Roth IRA conversions, we got plenty of information on that. Go back and review our previous episodes. It's an important topic that we talk about quite a bit with tax planning. I just bring that up now because this extra deduction for seniors will have an impact on how we look at the Roth IRA conversion planning. All right. Next item up, while we're still on deductions, number 8, let's talk about charitable contribution deductions. So we already talked about the state and local income tax. Remember, there's 3 major itemized deductions: state and local income tax, mortgage interest, and charitable contributions. If the 3 of those is higher than the standard deduction, it's worth doing the itemized deductions. Now, with the charitable contributions, there is a provision where even if you're taking the standard deduction, you can deduct up to $1,000 per person for charitable contributions on top of the standard deduction. So you could be doing standard deduction and both spouses do at least $1,000 of charitable contributions each. You can add $2,000 on top of the standard contribution. So it's providing an avenue for, and really an incentive now for charitable contributions, which might have been diminished if you were in the standard deduction instead of itemized deductions. Now you can deduct up to $2,000 of charitable contributions on top of the standard deduction. There is also a wrinkle, though, for higher income taxpayers. Again, if you're up in those top tax brackets, it actually sets a floor, which is a little unusual, but it sets a 0.5% floor on those deductions. So most people won't run into this, but if you're in the higher tax brackets, I'll use an example where, for easy math, let's say you have $1 million of adjusted gross income. We have to take a 0.5% of that, which is $5,000, and say, okay, the first $5,000 of charitable contributions aren't deductible. Once you get beyond that, then you can add it to that standard deduction. So it's a little bit of a wrinkle for higher income brackets, higher earners. I'm not going to go into more detail on that. It's just important to note that little wrinkle. But for the vast majority of people, if you're not up in the high tax brackets, you're going to be eligible for this extra $1,000 per person charitable deduction on top of the standard deduction. All right. Hopefully you're still hanging in there. We've gone through 8, and it's a lot of detail. We'll just bring this to you because it's going to be impactful when doing tax planning. And we're halfway through the year already, and we're going to be doing a lot more tax planning as we get into the fall. And as we always do, we want to do that in the fall, at least before we get to the end of the year, because it's really hard to do tax planning after the end of the year. So bringing this all to you, thanks for hanging in there. We're going to go through number 9 and number 10 now. So number 9 is a new item. It is an auto loan interest deduction. This can be taken by seniors, which by this bill is defined as 62 and older. And it can also be taken by, quote, other buyers. Now, other buyers are first-time vehicle purchasers, or a buyer that is trading in a vehicle more than 10 years old or 150,000 miles, or third, a rural or underserved area resident. That's based on zip code. So this is for seniors 62 and older, and these other buyers, first-time vehicle purchaser, trade-ins more than 10 years old or 150,000, or rural or underserved areas. What this allows you to do is deduct the interest that you are paying on an auto loan up to $10,000 per year. Now, the car must be U.S. assembled with at least 50% domestic parts content. So I'm imagining that the the dealers themselves, the auto companies themselves, will have to give you some information, or I don't know if they'll certify it, but they'll have to provide something showing you that, yes, it was in fact assembled here. Here's the percentage of parts that were domestic, things like that. So, not clear on the details of the specific mechanics of this yet, but just know that this is a new provision that allows a decent chunk of people to deduct up to $10,000 per year on auto loan interest. Now, we've already mentioned phase outs so many times. There is a phase out on this. It's $100,000 per person of income. So $100,000 for an individual, $200,000 for married filing jointly. So just keep that in mind as well, that there is an income limit. And this, again, we mentioned this on some of the itemized deductions, where we're going to have to plan for this in terms of things like Roth IRA conversions. This may be another item to where, if you're considering buying a car and having a loan on it, we have to look at this and say, okay, well, how much IRA conversion are we going to do? Will this impact the $10,000 that we could potentially deduct on the auto loan? There's a lot to factor in. That's just yet another item to be mindful of when we're planning out taxable income for a year. All right, the last piece are Trump accounts. Now, this is not so much specific to retirement planning, because this is for children. So if you are in the retirement years, you might still have some children that would qualify. Most people probably don't, but you might. So this is important to know for your child. But this is also important if you are looking for, let's say, multi-generational planning, and you're looking for a good way to give money to either your kids or your grandchildren. This is a possibility. So these are Trump accounts. I'm not sure if that'll be the official name. Maybe it will. I don't know. But that's what they're being called at the moment. And what they are is they are accounts for kids that allow for up to a $5,000 post-tax contribution per child. So when you talk about post-tax, think very similar to Roth IRA. There is no immediate tax benefit for doing this, but that account is allowed to grow tax-free and be taken out tax-free if it is used for some specific items. Unlike a Roth IRA, you don't have to wait until retirement age to take the money out without being penalized or something like that. As long as you are using this money for specific items, which we'll cover in a second, then it is tax-free. So what are those items? First is education. We're talking K through 12 plus college. As long as it's used for education, you can be taking the money out. In that sense, it functions similar to a 529 plan, where you can have that money contributed with after-tax dollars. It grows tax-free. You can use it to pay for education. You can also use it for a first-time home purchase. You can also use it for healthcare costs not covered by insurance. So think very similar to a health savings account. You can use it for adoption expenses, child or dependent care. You can also use it for vocational training. So it's providing an avenue where you could still separately, these are all separate accounts. You could have a Roth IRA, you could have a 529 plan, you could have just a brokerage account, and you could have now this Trump account. And they're all going to be very different. The Roth IRA is specific for retirement later on. Yes, there's some rules that allow you to take money out of an IRA early for specific uses. I get that. But you'll have that, which is much more focused on retirement. Then you have the 529 plans specific to education. Now you have these Trump accounts, which function tax-wise similar to the other two, but provide some more flexibility in terms of their usage. So I don't think it's going to eliminate the need for a Roth or 529 plan, but I think this could be a primary vehicle for planning if you want to give some money to the kids that they can use a little sooner in life than retirement, and they're also not just restricted to education. Now, on top of all that, the government is providing a one-time $1,000 contribution to the account. And those that qualify need to be under the age of 18 at the time of the bill's signing. So under 18 at the time of bill signing, they're going to be eligible for this $1,000. Now, don't run out and try to open an account. They don't exist yet. And it's going to take some time, most likely, for the institutions to figure out how to put this in place, how to report on it, just in general, how to manage it. We don't know what the timing on that will be. We don't know if they'll be able to do it quickly or if it will be later in 2025 or if this will go into 2026 by the time they get everything set up. But just a word of caution, don't go running out to your brokerage and say, hey, I want to open this account. They're going to say, yeah, good luck. Not quite. Hold on. So just know that this is out there. It's not going to be an immediate implementation, but it's something we need to understand from a planning perspective. And just for fun, they have income phase outs, like we've been talking about with so many different items that all seem to have different levels of phase outs. It's again something that we need to plan for. So the income phase out, in this case, the phase out starts at 75,000 single, 150,000 joint filing, and it goes up through 125 single, 250,000 joint filing. So just something to be mindful of. We're not going to go through the calculation on that, but just understand that there is phase outs based on income that we have to be mindful of. Those are going to be really important from a planning perspective because it could be something that impacts what you do personally in order to get the money into these Trump accounts for a child. So it's all going to be very interesting to see how this plays out, but it's just important to know that it's out there. We just don't know what the direction is going to be in terms of how much these get used or not. But it's nice that they're going to be an option there for kids in addition to the Roth IRA, the 529 plan. Now you have this Trump account, which is just another good way to have savings that will be tax free. It can grow tax free. It's not going to have a ton of time to grow if we're talking about things like first time home purchase or education, but it'll have some time to grow and it can still come out tax free when used. So definitely a good thing. Just another option with some more flexibility and just something we need to be mindful of from a planning perspective. So those are the 10 things that I was able to narrow down and focus on from this new bill. There's a lot more to the bill, but definitely these are the 10 things we need to be thinking about from a planning perspective. I promised you a longer episode and I delivered, but so it's probably about 3 times longer than usual, but there was a lot to cover, tons of information as we're going through the rest of the year. Be mindful of these items. Also be mindful of all the income phase outs we talked about. There's just a lot to think of, a lot of variables. Unfortunately, it did not simplify anything, but it gives us some more options, some more things to think about, and a lot more possibilities to reduce taxes if we can plan properly.